Good morning, I'm Nathan Garcia, and I wanted to share with you my insights from the recent high in the S&P 500. I had a friend of mine reach out to me and ask when the market's going to crash because he wants to put some more money in. And I had to reply that it's really not looking likely because of what we're seeing. And so what I want to do is just walk you through a few insights really quick just to fill you in, because you may be looking at your strategy. Maybe it's killing it if you're holding Amazon and healthcare stocks, or you may be behind if you're using a value strategy. Either way, the information that you see here will help you out. So this isn't personal financial advice for you. It's only for educational purposes only, and consult a professional before you act on anything that you see here. So yesterday we saw the S&P 500 hit a new all-time high, and according to the latest data from FactSet, what we know is that the S&P 500 is trading at 16.6 times forward earnings. Basically, that is a metric that tells us how expensive is the stock market. And when we look at that value, what we can see is that it's definitely more expensive than it's been historically. However, if we take into account the fact that interest rates are so low, that gives it a little bit more room, and it doesn't make the current value look too far stretched. The other thing that we have to consider is that earnings have been pretty good, and they continue to look like they're going to improve, at least for the foreseeable future. And really the big things that could throw the market off would be the trade wars, or we see the U.S. economy start to slow down. So here's a chart that shows you how the S&P 500 has performed year to date. The market itself is up about 8.4%, the S&P 500. But then when you look at the information technology space, you can see the value there is up about 7%. And then without the technology, the S&P is only up about 4%. So it's definitely technology that is leading, that's adding a lot to the market returns. And a big chunk of that is coming from Amazon. Amazon makes up, Amazon's returns this year have been about 65%, believe it or not. Index itself is up about 12%. You see this ETF, XLV, there's a performance there, really took off around April and has done very well since then. So when we break this down a little bit, you see large cap tech up 17.2% year to date. That makes up 54% of the S&P 500's 8.4% increase in 2018. Amazon, even though it's consumer discretionary stock, is a huge contributor year to date to market returns, and the weight is just 2.6% in the S&P 500, but with a 65% return year to date, it's 20% of the price appreciation this year, so it's very big. You also see that the healthcare index is up about 11.5%, but that makes up 19% of the S&P's year-to-date return. So basically, when we look at tech, Amazon, and healthcare, that makes up 93% of the gains that have come from the S&P 500 year-to-date. Now, going forward, we look at where will the market end up at the end of the year. A lot of analysts have predicted that the S&P 500 will end at about 3148. So today we're trading at about 2,900. That gives us about 250 points. The reason I bring this up is that we have a lot of momentum right now, given that this is a huge vacation week. We have lower volume in the market, not a lot of news coming out. But we could continue to see that momentum, and it kind of would put us at the top end, if you will, for where analysts believe the market will end. So the best case scenario would be an additional 8.7% by the end of the year. But the price target gives us a 17.1% return on the S&P 500. And if you look at where we've been over the past 8 years, since 2010, the market's returned about 14.2% each year. So that would be pretty aggressive, and if we continue to see the run-up, then essentially what you'd be potentially looking at is come November, December, things might slow down dramatically. Basically, if we get all of the gains in the next month or two for the year, you might see people, portfolio managers, investors start to sell off some positions and try to capture those gains while they're still there. Now, the big thing, the reason that I really made this video is because of the variance in the strategy. When we look at two different strategies, growth and value, we see that the growth index has done very well year to date. It's up about 14.5%, whereas value is only up about 2.1%. And so there's a huge difference there between the returns between those two strategies. So if you are under the belief that, you know, at some point the market's got to pull back and that this can't go on forever, you're probably investing in the value stocks, and as a result of that, your returns haven't been that great. But if you've just gone with the trends, if you're going with all of if you're following along with the market and you believe that tech is here and it's the new normal and everything else, then you've done very well. Each strategy has its pluses and minuses. It really depends on your personal situation. But it's interesting there looking at that because it's such a big difference between those returns. So going forward, you want to make sure that if you're in retirement, you have a diversified portfolio. Some things that could throw the market off. I'm really watching what's going on with the dollar, particularly as you hear announcements that come out of like Germany saying that they want to move to an alternative to SWIFT. You're starting to see more countries are comfortable trading outside of the dollar. You know, you see what's going on with China and Iran buying oil directly and circumventing the dollar itself. Also, as you continue to watch the market, you know, the data coming out of the housing sector has not been great. And so if that continues, then it could have a drag on the economy itself. And then beyond that, at some point, you may see people investors start to sell off some of the gains and basically take some of the house money and take it off the table just to make sure that they've done well for the year. So I hope that you found this helpful. As always, if you have any questions about your portfolio or your strategy, feel free to reach out to me and let me know what questions you have. Thanks a lot.